This news will shock the world. And if you think what's coming tomorrow is bad, just wait until you see what's coming over the next several months. Because right now it's all about the labor market, as people are asking what jobs number this Friday will it take for the Fed to cut by 50 basis points. And that means all eyes are going to be on the non-farm payroll report, because it's going to give us a picture of the U.S. economy, more importantly, the labor market. Now, I want you to understand why this is so important, because the stakes are high. For the Trump administration, it could validate that his policies are working. For the Fed, it could validate that they're on the right side of monetary policy. And for the U.S. consumer, it could give them some confidence that they're going to see pay raises in the future and that the economy is turning in their favor. But I think what's coming tomorrow is going to disappoint a lot of people. But what's going to happen in the several months that follow is going to be outright terrifying. Let's take a deeper look, because luckily we may have an answer for what it would take to get the Fed to cut 50 basis points, because Steve Englander, he's Standard Chartered's head of global currency, he says you want to see a non-farm payroll report below 40,000 and the unemployment rate at 4.4% or perhaps higher for the Fed to cut 50 basis points. And I don't think either of those numbers are likely to happen. And that's a problem right now, because if you look at investors, they believe that a 50 basis point rate cut will send stocks surging higher, and they're cheering for it. But the problem is they really don't want the Fed to cut here, because when the Fed starts a major cutting cycle, well, it usually tells us the economy is starting to unwind. And let's take a look at the payroll report here. I want to show you looking backwards from around the mid-80s all the way up into the 2000s, and let's look at the non-farm payroll report against the federal funds rate. Now, if you're wondering why I cut out the pandemic data, well, it's because it skews the chart and we really can't see it. But I want you to see how the Fed reacts to the payroll report here. Now, if we go back to late 1980s, we can see it didn't take much and the Fed was already cutting. As you can see, the federal funds rate in red dropping. In the mid-90s, well, what happened? We faced a soft landing in the economy, and many people said it was due to the Fed cutting rates. Well, you know what the Fed said later? We had nothing to do with it. We don't know why the economy turned around. We don't think it had anything to do with rate cuts. Let's move forward to the dot-com bubble. What happened? The payroll report was falling apart, and next thing you know, now the Fed is aggressively cutting. And this is the problem we're facing now, because that same scenario happened again going into the global financial crisis. So we've had several months of weak payroll reports. We're starting to see consumers get worried about the economy. They're worried about their job. They're worried about pay gains and hours. And that means we've already hearing signs that they're going to cut their spending into this holiday season. And for a lot of retailers and wholesalers and manufacturers, are sitting on massive amounts of inventory. This is a huge problem, because if that inventory doesn't get moved, well, what it means is there's going to be a lot of people on the unemployment line. But let's take a look at one of the issues that Steve is mentioning here. He says the unemployment rate has been at 4.1 or 4.2% for 13 out of the last 14 months, meaning, well, it's gone virtually nowhere. So it doesn't show any trend. And he said this is misleading because the employment population ratio, and that's shown in green, has dropped steadily over this period. So the problem we're seeing is people are leaving the workforce. They're giving up. They're losing their job, and they're saying, look, there's no opportunity, so why am I even going to bother looking? So the obvious thing here is to get the unemployment rate up. Well, we would need to see the employment population ratio go the other direction, and that's unlikely to happen. So what we're going to probably see from the unemployment rate is it's not going to really go anywhere. But what are the odds that we're going to see a huge drop in payrolls? Well, I don't think that's highly likely either. But Steve makes the case. He says that when correctly measured, net job creation from new firm openings is well below the BLS birth death estimate of around 90,000 per month. What he's suggesting is it's actually 70,000 less than that, or about 20,000 a month. Now, just because President Trump fired the head of the Bureau of Labor Statistics, does that mean that we're going to see that number get cleaned up and be more accurate? Probably not. So again, we're going to look at a payroll report that's probably going to be overstated. And in the past, that's been great for Wall Street. They loved it because they don't care about prior revisions. So this is an issue going forward. The unemployment rate is not likely to go up very much. And while the payrolls, well, they're looking like they're going to probably hold fairly steady here. But the issue, it's all about what is coming in the next several months. And we got some evidence that is looking very grim. Let's turn to Challenger Gray and Christmas, who said today that U.S. hiring intentions pulled back while job cuts announcements are on the rise. And that is a major problem for the labor market, because when companies start to announce layoffs, it doesn't mean people lose their job instantaneously. It just means over the next several months they're going to be cutting. And then again, you're talking about a lot of consumers here that are worried about the labor market, and this isn't going to give them any confidence. But something that should be giving you confidence, that's your trading account, and it should be headed higher. Let's review that trade on Platinum. I mentioned it just yesterday, and I said it was up big again, and sure enough, it's now up 5.89%. And my friends, I make it so easy for you to make money trading. I run the reports. I tell you, these are the trades that I think are going to be good. I give you risk control levels for all of them, and you just pick the trades you want and place them. It's that easy. And right now, we're changing the game because I'm using AI to go through all of these trading strategies and optimize them in a way that nobody else has, and we're going to have the edge. Again, I've been saying we're changing the way people trade, and you can get in on this right now. Grab those links in the description below. Use the coupon codes for your free 30-day trial, because right now you get my new meta strategy at no additional charge. Stay tuned to the end of the show for more information. Because U.S. companies announced in August plans to add just 1,500 jobs. And that's the fewest for the month, and data going all the way back to 2009. And of the 30 industries tracked by Challenger, hiring plans were concentrated in aerospace and defense, industrial goods, and retail. Announced job cuts jumped from a year ago to almost 86,000 and marked the largest August total since 2020. Excluding the impact of the pandemic, the number was the highest for any August since the Great Recession of 2008. Now, you might remember yesterday I said, look, we're seeing issues in the labor market where we have a supply and demand imbalance for workers, and this is something that doesn't happen unless you're in the middle of a recession. And now we're seeing the number of planned layoffs surging here this summer. But remember, we can think back just to the travel industry alone, and a lot of airlines said, look, if things don't pick up, well, what happens is we're going to cut routes, we're going to cut capacity, and that means we're going to cut jobs. So right now, a lot of consumers really need to see a strong payroll number here. This would bring people off the couch and back into the workforce. It would suggest that that imbalance is shifting back into workers' favors, meaning they're likely to see pay raises throughout the end of the year. But the problem is, I don't think that's what's going to happen at all. September is typically when we begin to see the large seasonal hiring announcements, and September is typically when we begin to see large seasonal hiring announcements, which foretell how retailers expect the holiday season to go. And coming off the lowest August on record for hiring plans, it may be a troubling sign. But it is a troubling sign because we just saw that survey from PricewaterhouseCoopers the other day, and what did it suggest? That spending plans for the holiday were going to drop significantly. And again, it's all about the labor market. And the issue here isn't what's happening tomorrow, because tomorrow is likely just going to tell us that things haven't changed much over the last several months. And I think Wall Street, on one hand, is likely to dismiss this because the narrative has been very clear. There's been too much tariff uncertainty, too much trade war uncertainty, and as that comes to an end, then the expectation will be, well, maybe businesses will hire. But they're not going to hire if consumers aren't going to spend. The problem is you're seeing a lot of these companies now, they realize it's not happening. They're putting out these planned layoffs. And I want you to understand the impact this is going to have on workers, because if you work at a company that just announced that, hey, we're going to lay off 10% of our workforce, you don't know if you're one of those people. So what are you going to do if you think you might be? You're going to cut your spending. And that's exactly what the global economy does not need right now, and that is the U.S. consumer pulling back. Because when the consumer pulls back, that means their confidence is going to drop and retail sales are going to go right down with it. And this is now what we're seeing, not just across that survey, but as well from Challenger Gray and Christmas. You can see confidence goes down as we look at the University of Michigan Consumer Sentiment Survey in red. Retail sales go right down along with it. And that's the risk we're facing right now. We saw a big surge in confidence coming out of 2022 due to the stock market, but when the economy didn't turn around, it rolled over. What it's suggesting, retail sales are going to drop. And as I've said, this is going to spill all across the supply chain. But for these planned layoffs, the issue is they're just planned. They're just announcements. It doesn't mean people have lost their job. But over the next several months, unless things change in a major way, those jobs are going to go, and then more are likely to follow. And let's turn to the ADP report today. And well, it doesn't really give us any hope because U.S. firms added 54,000 jobs, less than forecast. But the problem is the market really doesn't care much about the ADP report because it's not even close in terms of accuracy to the non-farm payroll report. But nevertheless, it gives us some indication. Had this been a large negative print, well, it would have probably spooked the market. But the ADP report showed wage growth was little change. And this is one aspect that I am very focused on because as we look forward to the next non-farm payroll report tomorrow, there is one underlying issue that I think everybody should be focused on. But I want you to see the experts care about wage gain. Well, that only matters if people have a job, but it's still holding up, but not for much longer. Workers who switched jobs saw a 7.1 increase in pay, while those who stayed put saw a 4.4% gain. And this is based on 25 million private sector employees. But the problem is those wage gains are about to go down. And that's what we learned from the JOLT survey yesterday, which you can see here in blue, against average hourly earnings of production and non-supervisory employees in red. And one thing that happens is business slows down, employers cut those job openings, and then because there is an imbalance in the labor market, particularly at a very unusual point in the economic cycle, they don't have to give their employees big raises. And what my expectation is over the next couple of months, that this red line that's been following the JOLT survey down is going to drop even more. Now, one thing that is to the benefit of workers is that wage gains right now are historically right around the peak of prior cycles, but I think that's going to drop off and in a major way. But we did see some job growth, but I don't understand why it's in this sector. ADP said it was led by leisure and hospitality, while construction and business services also added to the headcount. Trade, education, and health, as well as manufacturing, and that's a big one, shed jobs, just as we got validation from the ISM. And businesses of all sizes and across the region added to employment, but that is going to be changing in a big way. Now, we got a little warning sign, and then we got a big one. Let's turn to initial claims because they ticked higher today, now to the highest level since June. And they rose by 8,000 to 237,000. But is that really a big deal? It's not, because at 230,000, it's still historically very low. Now, if that number jumped to say 250 or 260, 280, yeah, then that would suggest that something's really wrong here. But in the next couple of months, as a lot of these planned firings go through, you're going to see that initial claim number start to rise. So for the moment, the focus is on continued claims, and well, it's little change at 1.94 million. I think if that gets over 2 million, it's game over for the U.S. economy. And there's a reason why, because we look at initial claims and we see that they follow continued claims higher. So the fact that continued claims aren't dropping here, well, it's a major problem for the economy. And here you can see continued claims in blue against initial claims in red. And as continued claims rise, well, initial claims follow them. Now, we haven't seen that yet this cycle. We saw a little bit of it going back to 2021, but since then, initial claims have remained steady. But if things don't turn around, what we're going to see is initial claims surge higher. And so this is a major issue. So, we talk about the importance of this pay report and all of the validation it can provide, or it's going to suggest that a lot of policy isn't working right now and that U.S. consumers are facing a very bleak holiday season. But let's turn to the services sector. We heard from the ISM today, and well, while the headline was good, the underlying indicators of what's coming for the labor market were anything but. As U.S. services activity expands at the fastest pace in 6 months, it's now rose to 52, which by number is an expansion because it's over 50. But for the services sector, really anything under 53 is really either holding steady or contracting. So this isn't a great number, but the trend is going in the right direction. And it's not just the overall trend. New orders index jumped 5.7 points, the most since September, to 56. The business activity index, which parallels the ISM's factory output gauge, climbed to a 5-month high of 55, indicating we're seeing a big rebound in the services sector. So this is perhaps the bright spot of the economy. But hold fast, because if you think this is leading to hiring, well, it's not. Other details of the report were mixed. A gauge of order backlogs dropped to the lowest level since 2009, helping explain why the service providers were in no rush to expand headcount. And I've been warning about these backlogs because we saw a massive buildup on the manufacturing side, then we saw them build up on the services side, and I said there isn't enough new orders to sustain the workforce. So when these backlogs are gone, there's not just going to be a few firings, there's going to be a whole lot of them. And now as we turn to the employment part of the services report, well, we find out that it was little changed at 46.5, the third straight month of contraction and one of the weakest readings since the pandemic. Now, does this mean people in the services sector are being fired? Not necessarily, because a contraction also can indicate a cut in hours. And we already know when hours get cut, well, what we face is eventual jobs that get lost. And this is a major problem, because sustained growth in orders and business activity is likely needed to encourage companies to step up hiring. No, it's needed to keep them from firing, and that's the problem. That's what we saw in the Challenger Grain Christmas report, is that we're seeing planned layoffs increase. Now, those could go away if the economy turns around, but what did we hear from ADP? The critical parts of the economy are laying off. And then what did we see in the continued claims data? That it's not getting better. And what the ISM here on the services side and the manufacturing side is saying employment is going to get worse. And so what is the most important thing about the non-farm payroll report tomorrow? Well, it's not the headline number. I know a lot of people are going to think that. It's about weekly hours, because if those are dropping, well, watch out. Over the next couple months, this whole thing's going to come unglued. And the evidence is clear. Let's take a look at that non-farm payroll report chart from earlier, and now we'll overlay average weekly hours of production and non-supervisory employees, and you can see very clearly where weekly hours go, payrolls follow. Now, we do know that weekly hours have been very static here for the past several months. The problem is, if we start to see that dip down, you could see the headline number still look okay and give people some reassurance. But if that number is dropping, well, watch out over the next couple months. What it says is we're facing a labor market recession. But again, as we started the show, what is the magic that it will take to get the Fed to cut by 50 basis points? Well, I don't think we're going to get that tomorrow, but right now the bond market is saying, look, 25 basis points is in the cards. Let's take a look at the federal funds rate in blue against two-year treasury yields in red, and you can see the bond market tells the Fed what to do. Talk about an easy job, because right now if they just drop down to 4%, and that would be a 0.25% cut, well, what you would have is the two are back in alignment here. So I think the expectations now from the bond market saying a 0.25 basis point cut is in the cards. I think a lot of people are going to be disappointed about the report, but what's coming in the next couple of months isn't going to be bullish for stocks. It's not going to be bullish for Trump's policies. It's not going to be bullish for the consumer. What it's going to say is we've reached a tipping point, and now we're facing a labor market-led recession. And when that happens, it's completely game over and all but assured that we're headed right into a massive financial crisis. But even if that happens, it doesn't mean you have to lose money in your trading account. Let's take a look at that platinum trade. This is up 5.89% as of close this business yesterday. Now, how did we do this? Well, this came to our CTA Timer Pro subscribers, and what we do every day is we look at machine positioning across the broad market. Now, machines trade with a back look of around 3 to 6 months, sometimes upwards of 12, but what we do is we run a historical overlay. So we look to see when the machines are off size and when they need to be big buyers, and that shows up every day right on our hot list. But in addition to that, you get the machine positioning across all the broad equity, bond, currency, and commodity sectors. And in addition to that, you also get our Metre strategy. And this is an advanced trading system that combines all 9 professional trading strategies into a single intelligent signal generator. It provides 31 times more frequent buy signals than individual strategies on their own, while maintaining high quality through multi-strategy consensus. Now, it's optimized for swing trading with a target hold of 2 to 15 days. It generates over 155 signals per year and has a success rate of 55% with fast profit taking. And right now, I'm in the process of AI optimizing every one of those signals, because we're changing the way people trade. We're putting the odds even more in your favor. Now, how do you get in on these trades? Well, you get the daily report. If you sign up, you're going to get the CTA report. You get all the tradable signals, including the Metre strategy. You get my opinion on the best trades. You get risk control levels. You get a full tracking of all our open trades in return, a weekly update. And again, here's the best part is you don't even have to put a dime out to try a report. All you got to do is grab those links in the description below, use a coupon code for your free 30-day trial. And with that, I'm Steve Van Metre. Thanks for watching. Thanks for being fans. Bye now.